Hey guys, welcome to my channel. Today is going to be sort of a market update, as we've seen a lot of red in the recent days and really since the beginning of the year actually. So I really want to help you to navigate through that to understand why is it happening. Should you be worried or should you change anything with your portfolios as well? So yeah, let's go straight into it. So as we can see, it's really across the board red all day long, with the exception of healthcare, which seems to be holding up pretty well, given that we have these new Omicron fears. But everything else kind of selling off, like especially fintech and tech in general, but also like yeah, consumer restaurants, anything really at the moment. And if you've been following the market for the last couple of years since the beginning of the year, you'd have seen that yeah, it's been going down pretty much every week. So 3% down for the S&P 500, which is quite a lot. Um, if you look at crypto, for instance, it's the same thing. Since the beginning of the year, we've really had this downturn. So which actually started in December already. But since then, it's been going lower and lower ever since. Um, but for the S&P 500, for instance, of course, it has been going down since the beginning of the year. But actually, if you go back 1 year, that little blip here doesn't really seem like much. If you think about it, from 1 year ago, you're actually still up 22%. Of course, you in the highs you were up 26%, but now you're still looking at a 22% gain over 1 year, which is pretty decent. So where's the actual pain happening? Because it seems like that the top of the S&P 500, the top large cap companies, they're holding up pretty strongly. They had a little correction, but they're still quite up. It is actually in stocks like Teladoc, which are more sort of growth related, um, and have a market cap of anything that's sort of from the 1 billion to the 20-30 billion market cap and growth related, that has been seeing an extended sell-off. So you can actually hear I've just been going down a year back, which in February last year we had this huge hype around growth stocks and Kathy Wood's ARK fund, and all of these kind of hyper growth stocks with had a huge valuation, were hugely overvalued. I was actually not looking into those back then because I just saw that they just keep going up and the multiples keep increasing, and yeah, sort of the risk and reward wasn't really there. But ever since it has been going down over the months, I got sort of interested in September, October time. That's when I started getting into those smaller caps, as I've seen things like Apple, for instance, which is the largest company in the S&P 500. They've just been going up and up and up. And the multiples on those, like looking at a PE ratio, well above 30. I mean, if you go to the forward PE, it's 32, which is kind of high for a company of that size, which is still growing, but it's not as nearly as much as it used to be when it was a bit smaller. So that's when I started scaling into things like TDOC, but also looking at much smaller companies with a 1.9 billion market cap, for instance, CRSR Gaming, which provides all the gamers with and streamers with streaming equipment and gaming equipment such as cameras and lights and controllers and so on. And those kind of stocks really, that's where I see the opportunity right now. If you look at it, yeah, it's pretty much the same picture as TDOC. Since February, it's just been going down really, had as high as a $45 per share. Now we are looking at a $20. Looking at quick metrics, for instance, this has a forward PE of 13, which is like absolutely ridiculous for a company that's still growing quite quickly, growing probably even more than Apple, for instance. Price to sales for one, so that basically means that 1 times revenue, 1 year of revenue, is reflected in the price, which is usually not the fact at all. It's usually more like anything from 3 to 10 for a smaller, higher growth company. The same with another small cap company, which is HIMS and HERS, which they do sort of sexual health products for HIMS and HERS via telehealth. So they kind of overlap a little bit with TDOC, but from a more, mental and sexual health perspective. So they have a 1.1 billion market cap. And looking at the metrics here, price to sales for only 3. I mean, they've just been IPO'd last year. Had as high as well in the February hype season, kind of in 24, which is now at $5.50. So that's sort of like a 80% drawdown or whatever it is. But it's been massively, like the sell-off's been massively. So those are just a few examples of where the actual pain is hiding. Because if you look at as we said in the beginning, if you look at the S&P 500, even though we had this year-to-date sell-off of 3%, over the past year we're still up significantly. So if you held sort of index funds or ETFs, you wouldn't actually really notice any big difference in your sort of account balance. Whereas if you were to focus on sort of growth stocks and your portfolio is only consisting of growth stocks and you've kind of investing since the highs in February, you would be looking at a 77% drawdown for some of those. I mean, this is just one example, but it really looks very similar with all of them. Another one would be Square, which was really hyped in the February season as well. Always been coming up again, but then since really November, December, this is when they've also started this huge drawdown. So from the highs down 47%. And so I thought it would be good to talk about why is that actually happening. So why do we have this drawdown, especially in high growth, small cap stocks? So I think if we're looking at the news, so there's really sort of 3 factors that affect the stock market right now. One is obviously the ongoing COVID crisis, the new variant Omicron, and that really cases go up, and we still don't know, or we still don't have a really clear picture of, is it milder, is it really not as big of a deal, or does it have a potential of having a huge impact on the economy and humans as well. So this is one factor, but then the other one is, which really started in November last year, November, December, is the ongoing increase in inflation rates. So we had the Federal Reserve in the US actually coming out and keep saying that over the past years that inflation is transitory and it's really gonna go down. It's kind of like when COVID happened, it dropped down because of the economy was shut down. Now we open up and it's hiked. And they thought, well, it's going to normalize again. Whereas new data every quarter basically suggesting that it's not really the case. So they came out with a speech saying, let's retire the word transitory. And then basically saying, oh, an elevated level of inflation is here to stay. An elevated level of inflation really means pressure on those sort of hyper growth stocks that don't really have that pricing power yet. So for instance, like an Apple or Google, because they're such a monopolistic company, they can charge whatever they want for their iPhones. Like if inflation goes up 5-6%, they just adjust their prices and nothing much happens to them. That's why we've been seeing really a sort of a move towards those stocks. So if you, for instance, look at Google for the past year, whenever we had that sort of inflation fears, people kept piling into those large caps, like they're all well above 1 trillion, and people just keep piling into those, which is kind of typical for the market. What it does, right? It always looks for what is gonna be helping me in this type of macroeconomic situation, and that's why they keep piling in. But everyone does it. So the problem is that prices for those stocks or assets keep pushing higher because everyone is thinking that way and everyone wants to hedge themselves to not lose money. So that's why they keep piling in. And we do see those elevated valuations and prices for stocks as a result. Yeah, and then the third reason is that the Federal Reserve, because of that ongoing inflation and the elevated level of inflation, they keep talking about raising interest rates sooner than expected. I mean, it was expected that this year they would start increasing interest rates, and also stop the tapering, which basically means stop infusing money into the economy from their side, which usually has a negative impact on stocks, not growth stocks in general, but especially growth stocks, but all stocks in general, as interest rates affect valuation models of stocks. So, so really what's been happening is that we had a first report coming out in December saying, well, we're looking probably at 3 rate increases next year with tapering to stop in around March. And then this is when you basically saw the first really drop, like in December, and then especially for growth stocks. And then what else happened was recently there was another report coming out saying basically, look, we might have to start it even sooner or be even more aggressive than what we thought we would have to be. And this obviously is really not good for any sort of small cap growth stocks. And it doesn't really matter if they have any debt. So you would think that, okay, they raise interest rates, that's bad for stocks that have a lot of debt, which is true. But in that fact here, it's really not that's what's happening. It's more like when you create a valuation model around those hyper growth stocks, there's not many earnings you can count on. So you're kind of projecting a lot of growth and you discount that growth, which, if you have a HIMS and HERS, maybe, let's take that for an example, you expect them to be profitable maybe in 2023, 2024. And if you have that high expectation of profits back then, the higher your interest rate is that you apply in your model, the more it gets discounted, so decreased to the current value, to the present value of that stock. So it means that, a $10 profit in 3 years because of that higher interest rate is much lower worth today as the interest rate is higher. So that, it's like as if you put something in your savings. If you have a $10 and you have a 5% interest rate, that $10 is going to increase way more than what you used to have when interest rates were only 1%, right? So your $10 would only be like $11 in 2 years. And now it's going to be $12, $13, $14 in the 2 years time frame. So this is why high growth stocks are getting heavily discounted and the stock prices come down, as it's just basically a mathematical calculation in that valuation model. So I think this is why we had seen a lot of fear and decrease in those hyper growth stocks, especially in the recent time. And then what's sort of another thing that's interesting is that Bitcoin last year was always mentioned as this could be a perfect inflation hedge, because basically it's a scarce asset, right? So if you have something that is scarce, there's a limited supply, it acts like a gold, right? Like it could be the hedge against increased prices, as the price of a scarce asset would have to adjust upwards if the supply is limited. But what we actually seen in recent months is that the fact that Bitcoin is still considered a very high risk asset is overwhelming the factor that it could be potentially used as an inflation hedge. So if you look at it, as soon basically as we had that increased inflation data and the Federal Reserve was talking about increasing interest rates earlier, that's when we really had that huge drawdown, which, to be honest, doesn't look like it has stopped yet. I mean, it's really been going down ever since. I think this morning actually we had like a yeah, we had a little dip here below 40K. 40K was that, huge support level, so we might see a further drawdown there. But what I want to get to is, so actually, what are you gonna do about it? So, I mean, are you gonna, if you invested in one of those, $1.1 billion stocks, are you gonna sell out now, or do you have to go all in on Coca-Cola and Apple and all these big companies that have the pricing power, or what should you do, right? I mean, it's really up to you. It's your preference. I mean, it's your portfolio and your decision in the end, right? This is just for entertainment purposes only. But from my perspective, if you have found good companies that you think in future are going to be worth a lot more, so for instance, HIMS and HERS has a huge growth ahead of them, and there's really no a reason to believe that this would be going down anytime soon. Then, and obviously, assuming that whatever you put in there you don't need anytime soon, I would just ride that wave down. Basically, if you want, top up even more your position, make it larger, because that bounce back that potentially is going to happen will be huge. Like if they only increase, if they keep showing in their quarterly and year-end results, if they keep showing that massive growth, then people will actually realize that they might outgrow that normal GDP. And the GDP is sort of what it's reflected in the stock market index. So if they keep outperforming that by their growth, then eventually they're gonna be, much higher than on an annualized basis than whatever your index fund is gonna return to you in the next few upcoming years. So if for instance HIMS and HERS keep reporting good data, then this data might be going up. Then the market cap might go up to 2 to 3 billion, which just seems to kind of still very low. But in terms of the stock price, that would give it a $10 to $15 stock price, so a double or triple from here. So I think this is where the potential is, and this is where the sort of the potential reward is, as such. So I would definitely hold on to that. If you believe that the company you invest in is really good, has strong growth, has limited debt, so limited risk to the downside, basically. I mean, limited risk to the downside doesn't mean that the price can't be a 4 tomorrow. The price could be 1 tomorrow, but the price is not what the company is. It's not reflected. So in the short term, economic news might make the price higher, like we've seen last February, where this was, what was that? It was around 24. So the price definitely was already there, so it has the potential to go there. But back then it was probably a little bit overvalued. Whereas now, because of the negative news, it's probably a little bit undervalued. So the market always reacts in the short, medium term very, very extreme in both directions. So if you believe that this company is going to be good in the next, 3, 4, 5 years, then keep holding and potentially increase your position, I would say. And this would be my strategy for this type of environment. I mean, it's kind of hard to see your portfolio keep going down every day, and you put money in, you put 1,000 in, and next week it's only 800. I get it. It's very sort of hard to watch that portfolio, but you really have to think about it as if you invested into a company, into a startup, and the money is just gone. I think that's the way you have to look at it, especially with those smaller cap stocks. So this is all I wanted to talk about really today. I hope this was helpful, and let me know any questions in the comments, and I will definitely cover. I will make more videos now coming up. I've definitely got back into it. And I will cover individual stocks as well going forward. This was just a more broader market update of what's happening right now. But but I would definitely cover individual stocks and go in depth on them. Yeah, hope you have a great day. Enjoy and see you soon. Bye.